Well, here's a good one. Why do banks make it so difficult to borrow money even for legitimate reasons for small businesses? Who wants to take that on? Leticia?
Yes, I have to. I think obviously the recession played a huge role in curbing lending. I just think in general we're more structured. We're, like you mentioned, which was great, we're less risk. We're not in the business to do high risk loans. That's a hard money lender. So we're looking for well-structured loans, sound businesses, and we have to, it's not profitable until the loan is repaid.
I have a question about collateral. Say you ask for a loan for like $10,000 and you're really starting, you're fresh, you don't have any real collateral. Instead of going to like the Bank of Dad and just paying him back, can you take that money and put it in an escrow account, and then the lender recognizes that as collateral so you can establish a borrowing history?
That's a good question. Do you want that, because it's a microphone, Teresa?
Can you repeat that question?
Yeah.
So basically the question is, can the loan be guaranteed by basically a CD, right? A
Yes.
deposit.
Right.
And
Yes.
we're a community lender and we're not a bank, but definitely that would be the ideal loan for us. Because again, we have 100% guarantee cash with cash. Usually we don't have those. People say, why borrow money when I have my own monies? So if we have someone that says, I don't want to use my money and I want to apply for a loan, establish the business credit, that would be the ideal loan for us, probably for any bank as well. We're somewhat structured like the banks, but as Leticia said, they're not really the banks taking the high risk. We definitely take a little bit more risk than the bank, but again, we still have to do our due diligence and underwriting.
Leticia, would you like to pick that up too?
Yeah, I echo what Teresa mentioned, and that's a great way if you want to get started with a CD secured loan to establish your credit. And even if you start small, 10,000 and you work your way up, that's just a great way to establish a relationship. Make sure you have your other depository relationship with that bank. That really helps.
We don't compete with banks, but I've got a question for you. What do you do when you decline a contractor that you cannot help out? I know Phyllis is sitting next to you,
Yes.
but we specialize in construction. Most of our business comes from the big national banks that either terminate line of credits or they term out the lines. So a lot of people don't have any place to go to. Who do you typically refer your contractors to?
Phyllis is definitely one we refer to, we work with. Some other, Teresa's just also one of the other ones. I'm glad you're here because now we know of another source to refer to some of the prospects or borrowers.
Anyone else?
Good morning. I'm just wondering, I bank with Wells Fargo, and I don't think I'd probably be able to qualify for a loan because I don't carry that type of collateral as of yet. But what about a credit line, an unsecured credit line with a good credit score? Would that be something that the bank may consider me for?
Just a credit line unsecured is very difficult for a bank to look at, especially for us as a community bank. I would say we would look at maybe working with the City of Phoenix, if you're in the City of Phoenix, and utilizing that Expand program. We do work with them, and that's a way to get maybe some financing started for you.
What kinds of businesses should not apply and why
Should not apply
for loan financing?
I guess for us, a typical decline on a loan request before even looking at all finances and whatnot is just the presentation of saying, our business is struggling and I haven't been able to meet payroll and meet my obligations, so I need a loan to do that. I think that's a automatic why go into additional debt. If you have not identified the problem, if you have not restructured your company to say, I identified, and with this loan I'll be able to move on and cover my losses and actually be on the right track, it's not going to happen. So that is the automatic decline for us to say you need to go back and meet with your team members and identify what the problem is, because this is going to create a bigger problem for you.
So most of the questions so far, so first of all, I'm Phyllis Rector. My company's the Interface Financial Group. I'm the factoring representative here on this panel. So we don't loan money per se. If you're waiting to get paid on a progress billing, we buy that progress billing, we advance up to 80% on it, take over the waiting period for you. We're also looking for growing companies, not declining companies, because I'm going to go down with you if you go down, okay? Because my money is out there financing your company. So we will, though, however, look at companies that are having a rough patch, have contracts that are going to start or contracts ongoing. You all know that there are hiccups in your business. Payments take a long time. Sometimes payments don't come in 45 days. Sometimes they're more like 60 days. And if you're trying to make payroll, the banks may not want to finance you. I would finance you as long as you're growing and you have invoices to finance. I think we have a question.
Phyllis, I run an air conditioning and heating company, and we are getting into new construction, and factoring seems like a possibility for us. The interest rate on your advancement for the money, obviously, you know, it's a very competitive field out there, so the profit margin is real low for us. Is that interest rate on that loan affect us on the profit side as quite a bit? Or?
Well, obviously your interest rate, whether you're paying it a bank rate or a factoring rate, is obviously going to impact your bottom line profitability because you just added another expense to your business. And I will say that factoring is going to be more expensive than a bank loan. And if I have a prospect that comes to me and I look at him and you say, why are you coming to me? You've got collateral, you've got earnings history, you should be talking to a bank. I would refer you to a bank. But you really can't make the comparison in cost between bank financing and factoring financing, if that's part of your question, because we're only financing people that can't get bank financing. So there isn't really a comparison there to be made. What we do in terms of pricing is we price for size. Larger transactions get a lower rate because if you are a larger company, you are less risky. And we are financing in probably the riskiest area of the business environment.
I'm just curious, what are your limitations as far as size invoices, size contracts? Do you limit what you can do? If somebody walks in with a very large contract versus a small?
So the structure, so the answer is, so first of all, we don't take over your entire accounts receivable, okay? Our minimum requirements are that you have to have 2 customers, and we would buy receivables from just one of those customers. We will do transactions as low as $10,000. Our minimum requirement is that your company needs to be doing $25,000 a month in revenue, okay? We don't care that you've done it for the last, well, in construction, we want you to show a history of 6 months. That's really pretty minimal, okay? In terms of the largest size that we'll do, and I should also say we do it from transaction to transaction. There is no long-term commitment. You don't need to finance your whole contract through us if that's not what you need. We actually, in my organization, we've done transactions as large as about $1.5 million. We have the capacity to do larger transactions, but frankly, larger transactions in the construction or anybody, probably you would be qualified for bank financing.
One more question. Do you warehouse your own fundings, or do you broker your contractors
Oh, no,
out?
I'm a principal. So I'm the decision maker. I actually have an operating company that helps out on the larger transactions who would be making the decision, which is, then I say I'm using my money. I'm using my money for the smaller transactions. We are the principals. We are not brokering.
A couple of questions here about startups, and a lot of my business is working with startups. Can you tell me, where can a startup go for financing to launch a new business?
Right here. We work with startup businesses. And I guess the biggest challenge for a startup business is really selling their product or their service of what they're going to be doing to the lender. It's really difficult for various reasons, and we do require a written business plan. We do require the collateral. We do not do 100% financing of the project. So we do always ask, what is your equity into your project? So basic is like everybody else, right? What's your cash flow? What do you project as far as your revenues and be able to repay this loan? What is, again, second, the collateral in case things don't work out? But again, we do small business loans, we do micro loans, and that goes with startup businesses.
Generally, for startups, from the bank's point of view, we will look at startups if maybe it's an offshoot of a new business, an existing business of ours is starting. And let me give you a great example. We have a company that's in different technology field decided to design and create a energy efficient shower head. And they got big contracts in the state of California to install those shower heads. And that's a startup, though. This new firm is a startup. So we were able to finance them using an SBA cap line, which is a great product to use. And to show, for a year they've been showing the profitability, doing great. Now we can move them to conventional financing. So that's a great way. If somebody just came in and looking for a startup loan, we have to see great experience, good liquidity, net worth, and good business plan to consider, but likely we would definitely look at government guaranteed lending for that.
Cool. I didn't know that. This question says, how can we consolidate our loans? So if a business has several different loans, they want to consolidate them all into one. And I think, related to that is, can a business refinance their loans, perhaps take advantage of a lower interest rate in today's environment than they may have seen several years ago?
So typically for our programs, we're focused on job creations, community impact. So for us to really look at a refinance project, it would have to really make sense, obviously, for the company. We're not a bank. We obviously are always looking for capital injection into our program. So the cost of our funds are typically going to be higher than the bank. And if we're doing a refinance, that means someone has much higher interest rates than we offer. And typically it's either a hard money lender or they want to kind of walk away from the factoring. And at that point, we consider the refinancing of any existing debt.
I would say from our end, a refinance is a big part of what we do, and we've seen in the last couple of years, especially on the government guaranteed side. So a lot of our 7A program is for refinancing, and a great example is an established business that sets up all the satellite related for the wireless technology. We refinanced all his vehicles and equipment, and saving him $5,000 a month with the longer term and amortization. So that's a great way to use a government guaranteed product and help his cash flow.
So some of our companies have never borrowed money before, and so they don't know whether they have any credit score, any credit rating available to them. How do you start to create a credit rating for a business, create a credit history?
In terms of the person, are you looking for more business, personal? You think both? Is that what you're asking?
I'd like to see it in a business context.
The business, how do you establish credit? So that's the main question. One great way is obviously through your suppliers. If we could look at that and see how have you repaid some of your suppliers. DNB is a report that we pull. Are any of you familiar with Dun & Bradstreet? Okay, so that's a report that we pull that gives us a great sense of how you're performing. It definitely, like we talked before, a CD secured loan is a great way to establish credit and first look at that.
Any other
I don't know if this is, question really pertains to these subject here, but the personal guarantee versus the business loan. I'm a contractor, and I'm noticing more and more every day that I'm being asked to sign a personal guarantee, but yet on the flip side of that, other people are telling me that I should not cross that line, and which holds me to a point where I can't establish credit because we're a new company, we're a new business, and it's very difficult for us to get help when I have a good credit score, but yet I have no collateral or anything else because I'm still a renter, and you know, I've been affected by the economy as well, so things are, you know, really tough for us. And I was wondering, should I cross that line on the personal guarantee, I guess is my question, for any of you three above up there, or should I stay on strictly business?
For us, every loan needs to be personally guaranteed. And I think that's as well for the banks, but I'm not sure when you say cross that line, what exactly you mean as far as crossing that line.
Well, I was told not to get my personal financing mixed up with the personal side, with the business side. I should keep them separated because I'm an LLC, and you know, if I sign on that personal guarantee, then I'm allowing, if something goes wrong, I'm allowing that institute to cross over and get me on the personal side.
Yes, and that will happen if you do sign a personal guarantee. So for a startup business, and we look at startup businesses, obviously we're going to look at the individual. There's no history, there's nothing to look at a company because we're doing a startup. If it's an existing business, we look at everything global. We go back 3 years or however long the business has been established, and we look at your personal, we pull your credit, we look at what you have personally and evaluate that. So for every loan, every applicant that applies with us, we're requiring for personal financials, and obviously we underwrite them personally as well.
And I would just add that we require a personal guarantee, and we kind of look at it as if you're not willing, I mean, you're asking us to put our money behind you, and if you're not willing to put your money behind yourself, why would I, right? And that's basically how we look at it. And when we pull a credit report, I mean, we will finance companies whose owners have poor credit. I would say not in the 400s, but certainly in the mid 500s, because we understand that frequently, I mean, first of all, there aren't any loans out there, there isn't any financing out there without a personal guarantee for small businesses. And we understand that your personal credit is going to be impacted by your business. But so as long as you show a history of paying, even if you have large balances on your credit cards, if you have a history of paying, that's okay. If you have a history of not paying, well, once you've not paid somebody, then it's likely you're not going to pay me. So I'm not interested. I think that's, I mean, it's pretty brutal, but nobody accused me of sugarcoating anything. So there you go.
I just wanted to add, I think everybody will tell you that there's always going to be a personal guarantee with a business loan.
Right.
Now, the reason though that you want to separate, you want to have an LLC or a corporation to separate your business liability effectively from your personal liability, but now with the personal guarantee, it seems like you're mixing it up. Well, you're only mixing it up for that loan. The fact that you sign a personal guarantee with a bank for a loan does not expose you then to personal liability on other things. Your LLC or your corporation will still protect you on all those other things. And that's really the main reasons why you want to do it, is not necessarily for loan liabilities, but you have other kinds of liabilities as well. Accidents, slip and fall, whatever kind of personal liabilities that may occur. Or there may be things that you can insure against, like errors. There are all sorts of different other kinds of liabilities that a company will incur that you'd want to keep separate from your personal business. But your loans are not going to work that way. But just because you open yourself up on one front does not open you up on all these other fronts, so long as you continue to maintain that, what they call the bright line between business and personal. Now, if you start mixing bank accounts and shuffling money around and all that sort of thing, that could be a little iffy. But as long as you maintain that bright line between this is business, this is personal, and my loan, I'm going to have a personal guarantee just on that loan, and it doesn't affect anything else, then you should be in pretty good shape. Anyone else? Yes, sir. Tina? Oh, okay.
I had a question that came up that was, the question was, does it make sense for me to go around and shop my loan package knowing that I'll probably get turned down, but I do have a bank in mind that I eventually want to get to, so I'll take these no's and the feedback and then take it to that bank, say Biltmore Bank, but I'm going to go to 4 other ones and get turned down and get the feedback to tighten up my loan package and then go to Biltmore. What's wrong with that?
You know, that's a great question. There's a lot of experience gained when you go to various banks, and especially from the large ones to the community banks and the regional banks. In general, I understand a small business wanting to compare banks and the different products that are available. If you have the time, I would encourage you to do that. I think it's much simpler if you go to 1 or 2, knowing who you really want to work with, and if they're willing to, if they have the appetite for your kind of product, you know, what you're looking for financing. I would just save time, get right to it. Somebody who can make a quick decision, get back to you within a week is what I recommend, and that's what we do. We want to see a complete package. So take the time to really put your package together. Be organized, be precise, review it, and then go to the bank and meet with them, and we'll get back to you within a week and say, okay, this is something we can entertain. We have an appetite for this. These are the structure or several options. Sometimes we offer a borrower 3 or 4 options for a loan and see what they prefer to do and what works best for them.
So I guess for us, we typically sometimes required that they go to a bank first, right? And some of our investors want to make sure that we're that option and we're not really competing with the banks, because some of our funds come from banks. But one of the things that I tell our clients or our prospects is that don't just look at the fee, look at the overall relationship of the bank. Because typically a bank, once they offer you a loan or give you a commitment letter, they say, well, you know, we want all your business relationship with us. So it's more than just that 1 or 2% or 0.5% interest rate, it's the overall relationship of the bank.
May I say a comment on the gentleman over there? Actually, shopping for a bank doesn't help, because we have been told that it reflects on, it dings our credit. When you have one loan package for one bank and then go to another one and go to another one, it actually, every time you submit an application, they look at your credit, and that goes into the FICO or whatever the score is there. So it gets dinged on us. So it's not looked at very well. That's what we had been told.
Some banks do pull credit right away. The larger banks definitely, I've heard, want to get right to the score, and they do more box lending. We do not. In fact, we don't pull credit usually until you sign a term sheet. So we're going by the fact that you've told us you have good credit, you've looked at it, there's no issues, we're not pulling credit at that time. So you can definitely talk to us, get an idea, and you should ask the bank. What I recommend any small business owner, ask them at what point are you pulling credit. You as, especially from a personal side, you should, definitely something to figure out and ask, but we do not do that.
Also about the personal guarantee, this is my question. How do large banks deal with large customers in terms of, like, there's a big corporation and they're looking for a loan thing with you? Do you still ask the board of directors or the executive management to put personal guarantees?
Our guarantees are based on the percent of ownership, so typically 20% or more ownership in the company we require a personal guarantee.
Which means that if you're a big company that may have stock or have lots and lots of owners, none of those owners may in fact own 20%. And so at that point, there isn't a personal guarantee. So it just kind of depends on the ownership. But a lot of large companies that are owned by one family or one person, yes, they're still on the hook for tens of millions of dollars, hundreds of millions of dollars.
So as a follow-up, what if there were 10 partners having 10% each, and they had less than 20% in each? So how would the bank look at that?
We always, I think it's a rare exception where, especially now, we do not take a personal guarantee. So in the case that sometimes it's structured or strategically structured to be under that threshold, we will still look to the main principal or principals, and we can ask of them and saying, okay, who are the ones that founded the company or the main principals or operators? We can ask them for a guarantee. I mean, you as a borrower can decline and refuse to do that and go to another bank and see if they will do that. But we definitely, as the other two ladies have said, we will always want to have someone personally on the hook.
So it's a one-way street.
So what we do in situations, and this would be situations where it's a larger company, say at least a $3-4 million company, which is not that large, but if we have multiple owners, under 20%, and we probably in that case would take a validity guarantee from whoever the CEO of the company. And what that means is that he's basically saying that he is guaranteeing on pain of perjury that everything that he has told us is true and ongoing is true, which gives us a little bit more firepower if there becomes a problem down the road against the CEO of that company that didn't want to sign a personal guarantee.
Okay, thank you, ladies. I sure appreciate this.